The Dow was up about 200 points today, so some nice upside here. Do you think we can peg this equity market momentum to that benign inflation print that we saw today?
Yeah, I think that coming out with a 0.2 print today was a positive. I think it got people to sort of tap the brakes a little bit as far as what their expectations are for the rest of the year with the Fed. And I think the biggest worries going forward now are, of course, any continued trade barriers, any type of talk about tariffs, and of course the Fed, which I just mentioned. But there's a lot of tailwinds right now. You know, we're coming off, we're just finishing a really strong first quarter earnings period. We're probably going to continue that into the second quarter. And, you know, the first preliminary expectation for Q2 with GDP is going to come in at around 3.7%, which is phenomenal. So there's a lot of tailwinds. We've got deregulation continuing to work through the economy. We have tax cuts. These are all positives.
Certainly, Bill, and equities seem to like this contained inflation and rates environment. But when you assess the outlook and look a little bit longer term, of course, the Fed is going to be hiking interest rates this year. Do you think that is going to be the catalyst for broader downside for stocks if we do see the Fed perhaps hiking a little more aggressively than what the market currently anticipates?
If the Fed were to go and become very aggressive hiking rates, yeah, I think that's a problem. I think if they stick to their plan of, you know, 3, possibly 4 this year, I think that's pretty much baked into the market, and I don't think that's going to have a huge effect. You have to remember, we're coming off a very low interest rate base, so we're just getting back to normal. And there's, you know, there's nothing wrong with a little bit of higher rates. There's also nothing wrong with a little bit of a whiff of higher inflation. That's always good for stocks.